be if Iran doesn't meet U.S. demands, there would be airstrikes, very public airstrikes on nuclear facilities in Iran. And the Washington Post has reported U.S. Defense Secretary Leon Panetta believes Israel could attack Iran as early as this spring. So let's talk about all of this, soup to nuts, currency wars to the actual ones. The man I have to talk about it is just the man, Jim Rickards. He's Senior Managing Director of Tangent Capital Partners and author of this bestseller, Currency Wars. And we're so thrilled to have you in studio. Nice to see you.
Thank you, Laura. Nice to be here.
First, I just have to thank you for being so sweet in your support of our coverage of Davos. It was really just very sweet of you.
Well, we were following you closely. You were on the ground and you were getting firsthand reports, and it was great reporting.
Thank you. Thank you. Let's move on to your fantastic reporting. I have this great op-ed from you, and I want to start with Bernanke, because he's been on the Hill a couple times, and people really focused on the dual mandate, because some are really interested in inflation and some are really interested in employment, and there's really this idea that one has to do with the other. Is there a relationship, though, between the two, as maybe economic models would imply?
Well, historically, there's been actually very little relationship between inflation and unemployment. We've seen examples in the late 70s, early 80s, where we had high inflation and high unemployment. We had to invent a new word for it called stagflation, the old Phillips curve trade-off where inflation could be lower but unemployment could be higher. That was the theory. It never worked out in practice. The fact is you can get bad results in both gauges. That was the misery index that Ronald Reagan talked about, and I think we'll see something like that again. You know, when the chairman says he doesn't seek higher inflation with regard to the unemployment mandate, he does seek higher inflation with regard to cheapening the value of the dollar. This is what the currency wars are all about. There's very little doubt. They're talking 2% inflation. What they want is 4% inflation. They want to shock people into thinking that inflation's coming like a runaway freight train. So we'll do what? We'll go out and borrow, spend, get that refrigerator, get that TV set, buy risky assets, et cetera, to try to get the economy moving. The problem is it's just creating another bubble.
Another bubble. And just to confirm, so the Phillips curve is just not even relevant.
You
can have high unemployment and high inflation, as the 70s showed.
Correct. Very little empirical support for that.
Okay, let's stick to inflation, because I want to bring up this chart that we saw on Zero Hedge. It shows the growth in the size of the BOJ, the ECB, and the Fed's balance sheets over the past year and a half, increased by 32%. I'm curious how much you think this is driven by these banks trying to prop up asset prices, as we've seen in the U.S. and Europe, certainly, and how much is competitive devaluation of the kind that you write about in your book?
Yeah. Well, I think the answer is it's both. I mean, you've got to prop up asset valuations to protect the banks. You know, if housing and commercial real estate and stocks and others found their sort of true non-manipulated level, the level they would reach without money printing by the central banks, they'd all be in trouble. So that's part of it. But then they're also trying to kind of inflate their way out of the debt, make the debt cheaper. You know, I've said before, we'll say to China, here's the $1 trillion we owe you, but it's not worth, you know, you can't buy a car with it.
Right.
So because we're going to print our way out of it, and historically that's what the United States has done. So again, I just, and by the way, 2% inflation, the chairman at his last press conference answering reporters' questions, he made it sound benign, like, oh, we can live with 2%.
Yeah.
2% will cut the value of a dollar by 75% in a normal lifetime. It's, you know, 35 years it's in half, and then 35 more years it's in half again. 4% inflation will cut the value of the dollar in half. But by the time your young children go to college, the value of the dollar is cut in half. So 2% and 4% are cancerous. These are not benign rates of inflation. I'd like to see zero, which means price stability.
And, you know, when we speak about that, too, I want to talk a little about 0% interest rates, because you have to talk about currency wars. You have a really poignant part in your book where you're talking about how couples actually committed suicide by putting their heads in ovens to have carbon monoxide poisoning in Weimar, Germany, when there was hyperinflation. I'm not at all comparing the United States to that situation, but there is a situation of 0% interest rates, of savers not being able to save, and it being dismissed as, oh, okay, you know, the economy's bad, so savers shouldn't be able to save. But isn't this the backbone of the economy? That's
exactly right, Lauren. Economists, you know, and Paul Krugman and others, Bernanke, talk about consumption and government spending, and they have this notion, this Keynesian notion of aggregate demand, and they say, gee, we're not buying enough stuff, the consumer is not there, so we need government spending to make up the shortfall in consumer spending. But there's another component of GDP, it's called investment. Why do they always forget the investment account? Let's have savings. Well, because I think they like a consumer-driven economy, they like inflation, they like to bail out the banks. Why not have an investment-driven economy? Encourage savings. Instead of forcing savers to go out and buy riskier assets, why not reward savers? Why don't we raise interest rates and make the U.S. a magnet for savings from around the world? And by the way, in Weimar, Germany, you know, economists like to say, well, we cheapen the value of the dollar, but so what? Your wages went up, so it all comes out in the wash. That may be true on average, but it's not true individual by individual. There are winners and losers. Well, we know who the winners are. They're hedge funds, they're bankers, people who buy gold, people who buy hard assets. The losers are, you know, teachers, firemen, people relying on a pension, insurance policies, annuities, anyone on a fixed income. Their savings are eroded by the Fed's policy. So it's really a wealth transfer from everyday Americans to the elites.
Yeah, a really good point. It's a wealth transfer, which
Right.
is what, you know, people don't often frame it in that way, and it's so important to do. I want to ask you about one currency wars related story that's just recently come out, because we were talking about the G3 central banks. New data shows that Japan has used what they're calling stealth intervention in November to stem yen gains, because earnings were getting hammered with
Right.
some of their exporters, from cars to electronics. Is this a kind of covert special ops currency wars with stealth intervention?
Sure, we've seen it in China with stealth purchases of gold, and now in Japan with stealth intervention. They're all just variations of the currency wars. And remember, the thing about a currency war, it's a zero-sum game. Not everybody can cheapen at once. If somebody's going to get cheaper, somebody else is going to be more expensive. So you have winners and losers. Lately, you know, the Fed and the Treasury have been trying to cheapen the dollar, which, by the way, implies a stronger euro and a stronger yen. But Japan's an export-driven economy. They need a cheap yen to promote their exports. So it looks like well, I focus a lot on the U.S.-China currency war, but there's a U.S.-Japan currency war going on also.
Well, you see the U.S. come out and criticize Japan's move, but isn't the U.S. doing the same thing?
The U.S. is the biggest currency manipulator in the world. Look, all major countries manipulate their currencies. I mean, let's be candid. The Chinese do it, the Japanese do it, the Europeans do it. The U.S. is just better at it than anybody else because we have a bigger printing press.
Yeah.
We sort of say, hey, you want to print money? We'll show you how to print money. We'll print more. And by the way, this is the key to QE3. If you see a weak dollar, there might not be easing, but if you see a stronger dollar or a dollar holding its own, that's the green light for QE3. And I think the Fed chairman has signaled that in a series of recent speeches and interviews. You can see the easing coming probably in May or June.
In May or June is your prediction.
Correct.
You'll probably be right, because you're not with the mainstream economist pack that is often wrong.
Well, maybe I'll come back in June and we'll see how we're doing. But that's how it looks from here.
I'm going to hold you to it.
Okay.
Just to back up quickly, when you said you think the Fed is creating a bubble, where do you think we're going to see that? Because
Well,
I should...
Sure. Well, because the main place you see it is in gold. That's the ultimate cross rate, and you know, gold did have that mini boom in August and then backed off a little bit, but now it's back up into the mid 1750s. I think that'll continue to get stronger. We're seeing in oil prices, although that's really a geopolitical factor because of what's going on in the Persian Gulf. But remember, if you can see an asset bubble, if asset prices just hold their own, if they're supposed to go down, if we need lower prices to clear markets and create new investment, but they're up here, even if they're not skyrocketing, that's a form of inflation based on the difference between where they are and where they should be normally if it was not being manipulated. And so that's a different kind of asset bubble. But the Fed, we're seeing it in the stock market. I've actually said this will be a good year for stocks, not based on fundamentals, but based on money printing. Wall Street loves free money.
Yeah, they sure love the easy money. Speaking of geopolitical issues, let's talk about Iran. With Rick Santorum winning several of the primaries last night, I was going back through his sound bites at the saber rattling at Iran, and he's certainly not alone. I mean, there are reports that there could be an Israeli attack this spring from multiple sources. First, let's talk about the currency war aspect, though, because you were telling me that there's a whole financial warfare aspect of this, and there was that report that, like, looking back, Iran has been diversifying out of the dollar and into gold, and then we've seen economic sanctions which have frozen the central bank and them from trading in gold. So there seems to be this whole currency war aspect there too. So maybe you could speak to those.
There is. I mean, Iran has been trying to get out of dollars. Look, they earn dollars in world markets by selling oil. Now the sanctions are tightening up lately, but they have a lot of dollars to their account. They've been trying to buy gold. They buy a lot of what's called scrap. I mean, scrap is just jewelry and cast stone, but it's gold, and a lot of it's smuggled in through Dubai. It can be melted down and turned into ingots. That's one source of gold for them. But what's going on right now, there's sort of two kinds of currency wars. There's the currency wars we've been speaking about, U.S. and China, where you cheapen your currencies to promote exports, except all you get is inflation. But there's currency war as actual warfare. And that's what's going on with Iran. What the United States did, the president imposed sanctions on the Central Bank of Iran, Bank Markazi, cut them out of the dollar system. Suddenly, if you're a merchant in Iran and you need dollars to buy imports, they had to double their local currency prices. Things went from 200,000 rials to 400,000 rials because they needed more rials to buy dollars on the black market so they could get the dollars to import goods. So their currency dropped 40% against the dollar in one day. Then we imported hyperinflation, and we injected hyperinflation into Iran because they had to raise the local currency prices. The Iranian banks raised their interest rates to 20% to stop a run on the bank because people were pulling the reals out to dump them into hard assets. So we gave them a trashed currency, hyperinflation, and 20% interest rates 4 weeks before the elections. And this is not a coincidence in my view, because what we're trying to do is generate regime change. So this is sort of trying to reboot the Green Revolution Part 2.
Wow.
Put their economy into total turmoil so that when the elections come, and they will be rigged, and the people will be disappointed again, maybe we'll get the Green Revolution again, all designed to get regime change to stop the nuclear program. So it's a massive play.
I want to keep continuing on this conversation because, of course, there is the alternative of what if there actually is some kind of warfare or conflict. I want to get your take on that. We have to go to break quickly, but we will be right back with Currency Wars author Jim Rickards. And still